Welcome to our third quarter version of In the Gaps. Glad to have everybody here. I'm joined today by our CEO, Mike Arougheti, as well as my co-head and partner, Keith Ashton, who co-heads alternative credit with me. As a reminder, just from a logistics standpoint, on the bottom of your screen is the Q&A button. If you put any questions in there, we'll try to add those in and make sure to answer them throughout the presentation. To kick it off, we're going to jump right into it just to make sure we get our full use of our time. The theme that's been here throughout the year and really started at the end of last year, which is what we're seeing with the ongoing crisis in the banks. What we've seen with regards to the banks is we've actually picked up our activity. Not only, as was publicly announced, did we do the $3.5 billion portfolio of PacWest, but we also at quarter end did a large significant risk transfer capital relief trade with a large regional bank. And the number of bank portfolios and the number of capital relief trades that are coming out of this fourth quarter has only increased every week. So every week we're getting new calls on portfolios. There's themes that are coming out of that we can talk about. But I think that you're at this point of, if you look at, like we looked last quarter at a $60 billion bank where they were paying 20 or 30 basis points a year ago. They're paying 2.12% today. That went up 52 basis points in the quarter. I guarantee it probably went up another 20 or 30 basis points this quarter, because when they're going after their deposits or their CDs, they're paying close to 5% or above. And so if you think of the liability side of the equation with that kind of a cost increasing, whether it ends at 3.5, 4, or 4.5, we'll only figure out. But the assets, half their balance sheet are generally fixed, and a lot of that's at 3.5% type fixed. And the floating rate part of their asset side is also kind of fixed because you're near the top end on SOFR. You're not really going up from here. And so it's not easy to be a bank CEO right now, right? It's a truly transformational moment. And what we're really seeing is the damage has already been done. It will continue to, show cracks in the foundations of these underlying banks that are left from the damage that was done. But this is something that's going to not play out over the next quarter. It's going to play out over the next 3 to 5 years.
Yeah, let's take a step back though, Joe, because you hit on a couple of the cross currents. And I think it's important that we probably drill down on each of them, right? One is the structure of bank balance sheets and some of the investing behavior that banks are forced to engage in, depending on the deposit betas, but also the cost of deposits. Right. So if you look at an SVB, they expose the reality that deposits are fragile, but also that they were taking in more cash than they can actually lend. So it's funny because we spend so much time talking about the origins of Ares and the growth in the private credit market. And most of us, or many of us, started off in other parts of the financial services ecosystem. I worked in commercial banks in my prior career. And the reason we started Ares was because we came to the conclusion that either because of the risk capital framework or the risk culture, they didn't really want to lend money the way that the market needed. So I think there's also this question of just kind of risk behavior. But all of this is happening, and maybe this is what I want to drill down on, at a time when you have the math that you just described, but now we're about to get a second wave of bank regulation. And then, we still have to see how the regulators deal with some of the weakness that was exposed in SVB. So it is, the math doesn't work, but it's also happening at a time when we're seeing sweeping changes in regulation. I don't know, Keith, if you want to drill down a little bit into some of those regulatory changes and the behavior that it's creating.
Yeah, I think from my perspective, one of the most intuitive elements.
Can you turn your volume up a little bit, Keith? It actually went too far down, I think.
Oh, did it? I'm so sorry.
Yeah.
Let me do that real quick. Sorry about that. How about now? Is that better?
Yes.
Excellent. Thank you. What I was going to say is I think one of the more intuitive but maybe lesser understood elements to this story is that we talk about the liabilities of the bank, the deposits, their cost going up, their stickiness going down. But another quasi liability here is the capital charges that they have to take against assets that they like and they want to keep, and assets that may not be performing as they would, the credit losses, expected credit losses. So there's these acronyms that banks are using constantly that I don't think most of the market is all that familiar with. The RWA, risk-weighted asset charge, or CECL, CECL, credit cumulative expected credit losses, and AOCI, which we talked about a year ago in our newsletter, which is the amount of mark-to-market loss on their balance sheet. All of these things absorb capital in a way that's a little bit like a liability. It behaves like a liability. The issue that the banks are struggling with, in addition to the deposit issue, is the fact that these criteria, goalposts, if you will, on how much capital charge they need to hold against certain types of assets, these are changing on them all the time. One of the reasons why some of the banks are disposing of certain asset portfolios or lines of business, or have exited other lines of business, is because while they used to get really good capital treatment for that, and therefore were able to conduct that business profitably, the capital treatment changed in many cases fourfold, tenfold, to the point at which it's unaffordable for them in this environment, given what they're paying for deposits in particular, unaffordable for them to continue in that business. And so it's really shifted the business model fundamentally. Now, whether that changes in the future or not, it is a clear and present issue that they're grappling with now, that is all part of this overall shift in capital needs from banks to private credit markets.
It's interesting. I think there's a view, which we hear a lot, that there's risk in the private credit markets that is somehow, accelerated or in excess of risks that existed within the bank or insurance market. And one of the things I always try to articulate is that the risks that we're taking are not risks that banks don't want to take. It's risks that banks can't take because of their regulatory capital framework, and because of the lack of leverage, the nature of the capital in the private markets, they're just frankly a better structured provider of capital to some of these assets. We'll obviously talk a little bit about credit, but the other thing maybe that's worth highlighting here is, and we're having conversations with all of these banks, we're not really having credit issues yet. I think we should talk today about where we may see credit issues emerging, but all of this seems to be happening at a time, and we'll see what the earnings picture looks like this quarter, but at a time when bank CEOs and risk managers seem comfortable with the credit exposure, right? So it's an interesting setup. I don't know, Joe, if you want to give a little bit of color into how that is impacting behavior and what they're selling and why, given the fact that, at least relative to historical averages, the credit seems to be holding up.
Yeah, we're seeing themes emerge for sure, both in the capital relief as well as with regards to the portfolio sales. The short version would be, they're selling and doing capital relief with what they can, right? They're doing it with their cleanest assets effectively. So if you think of a bank, as Mike said, I also started in a commercial bank background. And, if you think about it, everybody likes to talk about, the asset liability mismatch. Well, they have no defined liability. They have no defined duration. So of course you're mismatched. You're by definition mismatched, whether it's a year or 10 years. And so when you look at those markets, if you're a bank CEO going forward, you have to stay shorter duration, more floating rate, and more liquid, right? That it's going to become even more boring than it was before the failure of those three banks. And so what we're seeing is, what can they sell? Like on the PacWest, they can sell boring. They can sell very high quality assets that are floating rate and shorter duration. What can they do capital relief with? Very high quality assets, right? Because nobody wants to step into a capital relief on a office portfolio, right? The tranche wouldn't be big enough. It wouldn't work with it. So the stuff that they're doing is generally very, very high quality assets. We are also seeing a theme where, to Keith's point, where is the harder RWA going forward? Frankly, it was already hard for banks to lend to consumers. And it's becoming near impossible for banks to lend to consumers. And if you look at a regional bank, you look at a big bank today, and you say, okay, what's their balance sheet on the asset side? Half of it's commercial real estate, right, of different forms and fashion. Half of it's what we do in alt credit. It's student loans, it's credit cards, it's autos, it's unsecured, it's residential mortgages, it's all the rest. So a lot of it's consumer, all right, in different forms and fashion. And what's happening is, it's already hard for them. It's about to get worse with Basel Endgame and with some of the regulatory changes. So what you're seeing is there's a lot of consumer, but what can they do within consumer? They can't do the stuff that they're seeing stress in, the subprime and near prime, as we talked about, Keith, 2 years ago now, and in the gaps about the weakness we were seeing in near prime. We've been very, very underweighted towards consumer. Where can they play in consumer? Very high quality, the prime and super prime. And if you look at consumer right now between prime and near prime and subprime, there is a very big difference between the performance. Like, Mike, to your point, we're seeing good credit performance across our portfolio because we don't have near prime and subprime. Right. To be clear, the default curves on near prime and subprime are very bad. We're seeing curves that are getting back to GFC type levels on near prime, subprime. But if you look at the prime and the super prime consumer, you can't even tell anything is happening because they own their home, they own their equity, they're doing very, very well. So we're definitely seeing a lot of autos on super prime portfolios. We're seeing a lot of consumer on super prime type portfolios. We're seeing residential mortgages, but also they're all seasoned. So they're very safe to be able to do capital relief trades in. But frankly, there's a reason we're seeing it because that's the one part they can play with. That's the part of their balance sheet that they can do a capital relief trade on.
Keith, do you want to just, for the benefit of our participants, just talk about what does a capital relief trade look like? What is the actual structure and why does it work?
It comes in a few different flavors. I would say the most typical flavor that you see in the market is where a bank will take a portfolio. Say it's this auto loan portfolio. They're going to hold a certain amount of capital charge against that portfolio, but everybody understands that capital charge is really almost like a reserve against some extraordinary amount of losses that could appear in that portfolio. So I'll just make up numbers. Assume that in a prime auto portfolio, a disaster scenario might be 1% losses in total on the portfolio. So they're going to take capital charge against that. And what they're really trying to do is alleviate that capital charge by selling off that 1% to somebody else. And so there's a number of mechanisms for doing that. Very often it takes the form of some sort of the credit default swap or some sort of participation in that bottom tranche, if you will. That's the traditional approach that banks have taken with not just consumer loans, but it could be corporate credit and that sort of thing, where they basically transfer the risk of the bottom part of a transaction to somebody else. And then the regulators look at that and say, okay, you're not really at any risk here anymore. You can free up the capital that you were holding up against it. That's the way. But it comes in a lot of different flavors. And as investors, one of the jobs that we take is, where do we actually want, if we're looking at these things, what do we want to participate in, what the underlying asset is, how much credit protection do we need to see to get comfortable?
Got it. So could we maybe, if we think about the consumer as maybe the canary in the coal mine, I thought you guys did a nice job in the recent newsletter articulating maybe two high-level ideas. One is consumer spending is important, and we need to look at consumer spending as we think about what's happening in the real economy, but it's really about leverage in the consumer market, not just what they're spending, but where that capital is coming from. And I think I'd love to talk about that. But then two, priority of payments, which is something that you brought up too, which people haven't really focused on, but you mentioned mortgages. And one of the things that is different this time is people's mortgages, given that 60% of American consumers have locked in fixed rate mortgages below 4%, is probably now one of their greatest assets. And so they're going to behave differently in this market than they did, in the GFC and the subprime. So maybe let's try to get into some of that, leverage versus spending and understanding who's borrowing and why, and then maybe what we're seeing in terms of different consumer behavior this cycle versus prior.
Maybe I'll just start on just the spending versus leverage, just because this is such a hot button issue for me. It is so ingrained in how people think about the economy and how they think about recession that it's almost reflexive that folks will say, well, but the consumer's still spending. The consumer spending is still up. There's so many different ways that people anchor into that. And what we find is when we look through previous recessions, and in the newsletter we referred to the last 50 years, look at all the recessions, is that consumer spending going into and through a recessionary environment continued, like almost uninterrupted. And so for folks that want to use consumer spending as some sort of a leading indicator about what may be coming down the pike from a recession perspective, it is the worst one you could possibly pick. That said, one of the things that does seem to indicate an early warning signals is what we were saying. How is the consumer performing on their borrowings? And this is why we said, if you want to see where all the action is and where you're seeing cracks, if you will, it's not what's in the shopping cart. It's whether some of their bills are being paid on time, delinquency stats, loss stats. That's where all the action is. So anyway, that's my little.
You overlay the employment market and, tight labor, wage inflation, and kind of ability to service debt loads, or based on all the work that you've done on prior cycles, at the end of the day, there's not enough, marginal liquidity coming from the tight labor market to overwhelm this, potential for defaults to increase?
We're already seeing defaults increase, but again, more in your prime and subprime. So the thing we really highlighted in the newsletter was priority of payments, which goes down to, the last cycle, because people were underwater on their homes and their house was no longer an asset. To Keith's point, it was a liability. They let their homes go and they stopped paying their mortgages and they paid their autos. And so there's been this assumption in the market that, oh, but the auto's safe because I'm going to prioritize the auto in front of the home with regards to the priority of payments. Or sometimes people want to keep their credit cards available so they can kind of at least have that to kind of spend on a regular basis. And so priority payments is simple, which is you only have so many bills you can pay. Which one do you pay? Ironically, the one thing we didn't cover in the newsletter was the thing that I think when we've asked this question to everybody, what's the thing you pay first? The answer is the cell phone. That's a little different than it is in other things.
Yeah.
But that's definitely number one on everybody's list in today's world, which has changed. But it's flipped. When we went inside the data, when we looked at the data, what we found is that autos aren't first. The home is first because the home is an asset now. What was even more interesting, though, was not only, the homes just barely crept above the auto with regards to your first car. But what was really, and this is the geek in us, what was really interesting was multiple cars. The second and third car drops right off the cliff. Like it's way down the list. So you're at this period where you're seeing increasing delinquencies and increasing defaults from subprime and near prime. You're at this point where student loan payments have now come back and due again, where you have $1.4 trillion of student loan kind of coming due. So there's a reason in my mind that the consumers kept spending despite, with the labor market and others, but part of it's because we didn't have a credit contraction through COVID. We actually had credit expansion. So their checkbook is larger. Their ability to borrow, right, is larger than what it was. Normally, when you go through a cycle, you have credit contraction and you pull back the availability of what they have to borrow. I think that's giving this one little extra gas with regards to the consumer. But it is a very, very different tale of two cities right now between you've got some consumers prime that just are performing as well as they've ever performed. And then you've got near prime and subprime, and then they are starting to prioritize those payments based on what's important to them.
How much of this behavior, and I'm thinking back to just the conversation we just had about banks, and I talk about this a lot with you guys, what is a little bit different structurally is what we used to refer to as the Fed put. And if you think about bank behavior, the reality is not having to mark to market, at least up until this point, and being able to pledge securities at the Fed window has effectively had the Fed socializing what would have been losses that find their way into the market. And I guess the question is, you talk about student loans or you talk about COVID, is there a changed psychology within the US consumer that the Fed will socialize losses through loan forgiveness or aggressive rate cuts if they have to, and that maybe this time it is different?
Well, one of the shocking statistics that came out of some of the research we did on student loans, based on pretty broad surveys of student loan borrowers, is that 80% of those borrowers had some expectation of student loan forgiveness, which is an astonishing statistic on every level. So whether or not there is some, and there's already been some, which may be targeted or, one might say politically motivated, potentially the election year.
Yeah.
The reality is when you have that big of a population of borrowers who don't think they'll ultimately have to pay, it really does change behavior. Those expectations biases, honestly, are
Yeah.
a big driver of how they think about spending and saving and how to think about that prioritization. When reality hits and they realize they must start paying for this and forgiveness isn't coming, what does that do to the household balance sheet? What does that do? Where does that student loan now fit within that priority of payments, and what gets pushed lower? That's where I think it's kind of an interesting phenomenon, because there's a big unknown. Nobody knows what 80% of borrowers are going to do when they realize they aren't going to get forgiven necessarily.
Well, the thing also that was shown in the data was on student loans, all the correlations of prime, subprime go away, right? The levels of debt they have, their payment ability, what they're showing with regards to their payment history, what they're doing with deferrals, prime, subprime, near prime, they all kind of start to look the same. And so it was interesting in that you would expect that prime would be fine and there would be no issues, but I think it is because of this expectation management. I mean, one of the things that's been lost a little bit is, the administration's been talking about, well, it's not going to hit your credit report if you don't make payments between now and basically the first year. Well, to be clear, you're still paying default interest and accrual interest and other fees. I don't know that that's really been understood, because people have gotten out of the habit of paying their student loan debt, whether they're prime, whether they can afford it or not, right? Yeah. And that's going to roll through, and it's actually going to create some really interesting consumer behavior on a going forward basis with regards to student loans as well as other asset classes.
So maybe with that as a backdrop, let's talk about what that means for the world of consumer finance going forward. So you've got this void that's being created by regulatory capital frameworks and just the basic structural imbalance on the bank balance sheet model. You have this, as you guys are seeing it, kind of building up of potential credit issues at a time when banks will need to either divest or de-emphasize large portions of the business. How do you see this playing out in terms of the role of the private markets, as being a solution provider both to the banks and the consumers?
Well, I'll add one more layer in, which is fintechs, right? Fintechs were being treated as tech companies and not as financial services companies. And they were trading off of very large multiples that had nothing to do with their underlying assets. Yep. You're seeing a collapsing of values and a collapsing of reality with regards to fintechs too. And to be clear, there'll be a lot of fintechs going forward, but the model will be different. The model had been get to be public, has nothing to do with regards to my price to book. It was much more relevant to my growth, grow, right? Like a lot of things that have happened across venture, you're seeing that balloon pop, where a lot of the existing fintechs, what you're seeing is some private equity and venture capital firms that back some of those companies are saying, wait a minute, this is going to trade off a price to book value. I'm not funding these losses. This makes no logical sense. I can't get there. To me, that's the dot-com era. Fintechs are going through their own version of the dot-com era. They're going through the reevaluation of, wait a minute, I actually do need to make money. I am going to trade off a book value of equity. There's going to be some very large players, and there already are some that are already profitable. They make good money. They have a decent valuation, a reasonable valuation going forward. They're going to consolidate. There's going to be a whole bunch of guys that just go away. But there's also going to only be a growth coming out of this. It's not just a private credit growth with regards to the way that we attack and others, but even across fintech, you're going to see a growth coming out of this. But first, there's going to be some carnage. There's going to be a carnage with regards to a lot of those groups that don't have a business model that makes sense on a go forward basis. So
yeah, I think that it costs capital too at the end of the day for them, and that big reset. And as we've talked about, an unwillingness going forward to invest in profitless innovation, right? There was a time when we had low rates where people were willing to invest in profitless innovation. It just feels like it's going to be a while till we get back there.
We, as we like to say, as one of our lessons learned, buy assets and cash flow. The rest is noise. You know, gravity is buy assets and cash flow. Everything comes back to assets and cash flow at some point. And, you know, if you fast forward to your point, there needs to be a cost of capital. There needs to be a financing. It's going to get more attractive because the asset yields are going to widen. And you're going to see not only are the banks exiting, but you're going to see this reconsolidation. So it's going to become a really attractive opportunity that's only going to continue to grow from here. I think across Europe, you're going to see insurance regulations change because they're going to realize they were underweighted towards assets that they want to be in and the asset-backed securitization market. You're going to see the US asset-backed securitization market grow to a whole nother level of size and scale to offset that portion. But there's a little shakeout period here that has to kind of occur before you get to that.
And when you say the asset-backed securitization market will grow, do you mean privately, publicly, or both?
Both. I think that's one of the things that's changing right now, which is there's the public issuance, which was pretty much 99% of the market for a long time. And what you're seeing with us and with other players is you can go speak for size, take the whole thing down, get it rated on a private rated basis, and provide that access. It ends up being sometimes less fees to the originator, right? Even if the spread is slightly wider, but you're not paying some of the banking fees and other things. And so that creates a whole nother market and opportunity. That market's only really getting growing. And if you look at today, it's still not even probably 10% of the entire market. That over time will grow to be a much larger portion, especially with some of the larger consolidators and larger private credit markets, where you are going to have that private market that becomes more attractive. Because what it does is it's almost the same correlation to corporate direct lending versus the leveraged loan market. Would you rather, as an issuer on public, you know, if you think of the leveraged loan market, go out there, have a banker do a deal, hope that it gets priced at a reasonable, but you have full flex with regards to certain terms, or maybe the bank committed to it and they're getting hung with it, but either way. Or in the ABS market, you're fully open to the market. You go to price a public deal, you have no idea how it's going to price. The rates can change, what happens with regards to interest in the various levels. Or you go to somebody on a private basis and you're done. It's totally done. You know where you are. So from an execution standpoint, just like we've seen the market share grow on the corporate direct lending side of things, you're going to see the market share grow on the private ABS side of things with regards to the growth as well as the opportunity set.
And so the listed market becomes the purview of larger platforms selling through the large banks, GSIBs, and then the gap between those markets and the private market widens, similar to what we've seen in other markets.
And I think both parts grow. I actually think because of what's happening in the banks and others, I actually think the entire denominator has to grow, let alone the market share changing.
Interesting. I want to remind people, if folks would like to ask a question, just feel free to put it into the Q&A and we'll take it as we go. Sorry to interrupt you, Keith.
Oh, I'm sorry. Yeah, you're right. We should make a note of that. The other thing, I mean, you mentioned about the role of private markets. I mean, again, I'm kind of maybe oversimplifying here a little bit, but here we stand with the situation where you have banks that are looking to shift assets or shift risk. They aren't shifting that risk to other banks. Everybody's in the same boat. So there's a role for private credit there to provide a capital solution in many of these cases. And then you also have, you know, as Joel and you were both saying, banks are have to come to a different business model, right? Their cost of capital is higher, their capital charges are higher. They're not going to be able to do the same kind of asset finance that they used to do. And it's going to leave, it's, you know, as we are fond of saying, that we live in this world of have and have nots. And I think it's going to create a much bigger pool of those who would normally or otherwise have gone to a bank to get financing, and now they can't because the bank isn't going to be in that same position to do that, which again, I think creates an opportunity for private capital, which all of which does rhyme with the big
change. And maybe stating the obvious, if you look at the US banking system, you have a couple of things that are fundamentally different than most other developed countries, right? We have 4,000 FDIC insured banks in this country. I don't think we need 4,000. Even if we had 1,000, that would still be, you know, multiples and multiples of any other developed country. So, you know, there will have to be, I think, a move to consolidation and simplification, right? Banks in most other developed economies perform much more like utilities than securities firms, the way they do here. But I guess the other thing that a lot of people don't talk about is we have some very entrenched financial instruments in our economy, like 30-year fixed rate mortgages that don't really exist in other parts of the world either, that have driven, you know, certain frameworks from the banking system. And I guess the question is, do you think that part of what we're also going to have to do, to your comment earlier, Joel, about duration and rethinking, does the product set need to change in order to make the bank model more durable or more viable? Or does it keep doing what it's doing, but it simplifies, de-risks, and that innovation on product happens in the private markets?
I got asked by an LP the other day on whether banks need to exist. And it's an interesting question because it kind of goes to, well, yes, it's the, you know, if you think of money makes the world go round and credit makes money go round, you know, the balloon that inflates and deflates, that creates recessions and creates cycles, is credit, right? The air in the balloon is credit. And so on one side, it's like one of the greatest money multipliers that exists, right? Is the banks, and it drives the economy. Now, the caveat to that is now you have securitization, now you have insurance, now you have private credit, which also are that money multiplier that go through. And if you look at their models and you say, okay, private credit, insurance, banks, the most flawed on an asset liability mismatch is banks, right? Insurance matches, private credit matches with regards to term and doesn't use that same portion. But if you look historically, there's a correlation. This is a geek thing. You haven't heard this yet, Arrow. You'll like this one. There's a geek thing. I got asked this question by this LP, and I Googled this, which is there's a direct correlation of bank size to GDP if you look at US and Europe. If you look at the size of the total assets of US banks, I'm going to get this number wrong, but effectively the US GDP, I believe, is around $23 trillion. Bank asset GDP is around $24 trillion. And if you grab all of Europe and you say, okay, how much is all of Europe, not individual countries? It's about $22 trillion and it's about $23 trillion. They're basically 1-to-1, you know, which really does go to that whole, you know, it drives the economy another piece. Where you don't see as many opportunities sometimes in private credit, you know, if you think of what you mentioned with regards to a different mortgage market, Canada is always a little bit tighter. Japan, Korea, if you look at those markets, their banks are 3 to 5 times oversized compared to their economies, right? Compared to what you see in others. So you are going to see different things come out of this. You are going to see UK, Australia, and Canada, as it relates to the mortgage market, where they have 5-year resets on variable. They're in a totally different ballgame than what you are in the US. I think they're going to move towards a 10 or a 30-year type of a mortgage market, because they're going to realize that creates all kinds of issues that will roll through their housing market that frankly won't roll through the US housing market. But also, who owns that risk? It's not the securitization market. It's not the private credit market. It's not the insurance market. It's the banks, right? It's the banks in those countries that own that risk. So it's a very different model. So I think you're going to see some shakeout that occurs with regards to where those assets are held and on a country by country basis.
Yeah, it goes back to what I said earlier, is like it's interesting because we don't quite know, but there's something to our system's ability to socialize loss in a way that is unique, that I think is smoothing some of what we've all expected the volatility would be. The very point that we have time, given the duration of the installed base of credit, is actually, while it's amplifying the challenges, it's also protecting the system. We have had a couple questions come through, guys, so let me just maybe hit these. Which types of assets are better suited to the private ABS market and which are less suited? Like if you differentiated autos, consumer, like are there certain assets that work better privately versus in the listed market because of the nature of the underlying?
The answer is all of them. If you look at it, it really is everything across rated ABS you can do on the private basis. We definitely see a higher portion towards consumer, right?
Yep.
And part of that's the short duration, right? It's kind of like, hey, look, let's short duration. Let's just do this as a static pool. Let's just do this as a portion. But if you look at the underlying asset classes, it's been done on mortgages, it's been done on autos, it's been done on consumer unsecured, it's been done on rail, it's been done on aircraft. It's not like this has been done on every asset class that basically exists. The one that you don't really see it as much, now that I say this out loud, is CLOs. But there's no reason it can't be done on CLOs, right? That I think that market's been pretty efficient, frankly, and it's always balanced itself between the arb. But otherwise, the answer is any of them could be done on a private basis.
Maybe asking the question from a slightly different angle, referencing the earlier commentary around RWA, is there anything in the reg cap framework that will push certain of these assets quicker or more quickly into the private market versus others, or it's from the regulator's perspective, they're generally expected to behave the same way, and it's just a question of, you know, what your exposures are in any individual banking institution?
If Basel Endgame goes through as is, as you've heard from Jamie Dimon and other bankers, residential mortgages and anything consumer will definitely be pushed out of banks in a big way, because their treatment and their ratio, 20% change. It's a very, very significant change. And the only way you can deal with that is either do capital relief, sell assets, run off assets, or frankly, just stop lending across those asset classes. So now, do I think between now and the end game we'll end up exactly where we are? No. But I think we'll end up somewhere in between, and I think it will have an impact on those asset classes. Any others, Keith, that come to mind?
No, I think you're right. I think there's probably two little, I wouldn't say nuances, but element or facets here that are important. This entire market started off as a private market, and it was only until certain sectors or sub asset classes became highly standardized and therefore liquid, that the real liquid side of the market emerged with a lot more standardized thing. What we found consistently over the last 25 years is that issuers sometimes want the cookie cutter execution because it's efficient, and sometimes they want something that might be a little bit more bespoke. I don't mean like crazy different. I just mean they just might need a little more flexibility and a little bit more tailoring to a transaction than they would be able to get from the liquid side of the market. So we've always seen kind of coexistence here. And again, I would say it's very similar to what we see in corporate land, where you could have something very standardized that gets syndicated, and you could be a lot more tailored and on a private solution. We get the same thing.
Yep.
The only thing I would say that would be that would potentially be a little bit more present in the private side of the market versus the public is sometimes smaller transactions, sometimes, and then sometimes transactions where there isn't yet a long enough history for a rating agency to go through their criteria. And those criteria are based on whatever they've decided they need to see. So sometimes it's earlier stage, I won't say early stage, but earlier stage sectors. Think of solar finance going back not that long ago. It was a brand new sector in 2015, and it's now quite standardized, but it started off private.
I think that's changing though, Keith, because I think as the size of our group and other groups are growing, you're seeing that it's just like corporate direct lending, right? Your ability to speak, they were smaller because the capital there was 2 to 250 or 300. Now that you can do 500 million or $1 billion, that's changing with regards to the size of the deals. And if there was a question here with regards to, middle market CLOs carry less leverage than broadly syndicated, do private ABS carry less leverage? The answer is a lot of the deals getting done now, private versus public, look exactly like the public, right? The assets are the same. The advance rates are similar. Sometimes they're a little bit more conservative, but that's sometimes because the originator just decides to hold more at the bottom. But I think a lot of times you're looking apples to apples on the assets, on the rating, on the tranche, on the performance. I'd say sometimes because it's private, you can hand select a little bit more. One thing that happens on the public, you got to remember, is an investment banker puts on a warehouse. They decide to securitize it. The market has to take it as is. On the private, you can actually tweak it and customize it along the way. For tax and other reasons, you're not allowed to on the public. Like I can take it or not take this bond. And so you do generally create a little bit better structures, and you can carve out certain assets and certain other things, but the tranches and the leverage look pretty much similar to what you'd see on the public side.
Yep. Thanks for picking that. There's another question here that I actually think I get this all the time across everything we do in private credit, which is, I think everybody now sees the role of private credit in filling the void that's being left by the banks and other, pockets of the capital markets. But as the private credit markets get larger and more, quote unquote, bank-like, and I'm not sure that I would use that term, is there a risk of increased regulatory scrutiny, and how do we think about that? I'll put that to you, but then I can give you my views too, because obviously private credit, we touch a lot of different segments of it, and I have some pretty specific views on it as well.
Look, we're already very regulated, obviously, in many different ways. But having said that, if you look at the cause of regulation, it's supposed to be for too big to fail, or it's supposed to be for systematic risk, right? That should be where regulation should be coming in. As we've talked about throughout this, I mean, the systematic risk does exist inside of banks because you don't have match funding. And what feeds a bank? The Fed, right? The government creates, the only reason banks exist is because the Fed is there. And so they should be highly regulated. They should be boring, right? Because effectively, if you think about the risk, it's all that it's being created by the government, basically creating the system that kind of does that. If you go to other markets, if you think of even insurance, some of the regulations that are there in AIC and others are because some of that is protection of the underlying retail, of the underlying consumer with regards to that portion. If you look at most of private credit, it's mainly institutional. If you look at private credit and you look at the funds we run and other things, you're talking about basically most of them are unlevered funds. If they is any leverage, it's very token leverage across that. So from a systematic risk standpoint, it's not even in the same zip code. It just isn't. Even if Ares and our other peers were 20x the size they are, the structure of it is not the same systematic risk that you have in banks, or you even have insurance, frankly, with regards to that. So I think it gets lost, and I think it's because it's misunderstood in many ways. But if you just look at it in its simplest basis, which is what's the liabilities and where are those liabilities coming from, it doesn't exist. The funds are matched. The liabilities are matched if there are any liabilities. There isn't a systematic risk to what we do across private credit.
Yeah, I think the places that people look, or regulators look, are where's their leverage in the system, because leverage amplifies risk. So, right, bank balance sheets are levered 10 to 15 times. Insurance company balance sheets are levered 10 plus times. So you first have to say, where is their leverage? And I think generally, to Joel's point, the private credit markets are unlevered, and that takes a lot of the risk out. And where they are levered, they are match funded in their leverage, meaning they're duration matched and they're floating to floating. Where there's leverage in the system, typically, which is the systematic problem structurally, is they're leveraged and there's an asset liability mismatch. So I think you first have to ask yourself, where is their leverage? Where is there a mismatch, to understand where the regulators will go first. And it's interesting, if you go and you look at the recent FSOC report that came out 3 or 4 months ago, where they're going market by market, there's actually a 3 to 5 page write-up on the private credit markets that we're talking about, where they basically say, because of the lack of leverage and because there's no therefore mismatch, there's actually more stability in those markets than in other places that they're thinking about, like money markets or crypto exchanges, or places where there's maybe a perceived lack of transparency. And I think Joel hit on it too, which is where anytime investor or consumer protection is brought into the picture, that starts to, become the focus area for the regulators. So there is potential that as the private markets are touching more retail investors and retail consumers, that there's some regulatory body that would try to increase oversight in the name of investor and consumer protection. The problem, I think, is in order to see that develop, you're talking, years and years, if not decades, to figure out what body that would be to effectively legislate the relationship between an institutional private investor and an asset manager. But I think more importantly, and this goes back to the maybe the arc of the whole conversation we've had today, the private markets exist symbiotically with the public markets and the banks. And we've been trying, I think with success, to articulate that this is not a competitive relationship, or it's actually a collaborative relationship where, because of the nature of our capital, we can do things that banks can't. So I think if the question about regulation was really about what could, slow the growth of private markets or private credit markets, I would encourage folks to think about the regulatory overlay for private markets always in relation to the regulatory framework for banks, insurance companies, and the capital markets. And as long as we are less regulated in terms of the flexibility of our capital, there will always be an advantage in terms of the types of returns that we can generate for our clients. And so I think, you have to, just looking at private market regulation in absolute terms is only part of the picture, because you have to say, what does it look like on a relative basis when you think about capital flows through the banking market and the insurance market?
One thing I'd add to that, because I've been asked questions about this before, and people say, well, what about LTCM? What about long-term capital management? It's worth saying that when you think of that's always the example people try to go to, but long-term capital management, one, it was hedge funds. It was a match funding problem. It was short-term liabilities with long-term assets. But to be clear, long-term capital management was not a bailout of a hedge fund. It was a bailout of banks, right? It was because the banks had lent way too much money to them. That was 100% because of the banks. That had nothing to do whatsoever with the funds.
Yeah.
And so it really was, once again, a bank bailout because of that match funding issue with regards to that. And that's why the regulations has pushed to some of that. But I fully agree. We're here to partner, not compete.
Yeah. Gentlemen, we're almost up on time. There are one or two questions that we didn't get to, and I'm grateful for everybody's participation here. We can get to those offline, but maybe in our last couple of minutes here, I just wanted to pivot to the work that you all are doing and have really catalyzed firm-wide on the philanthropy front. And I'm not sure if the participants on the call are aware of the history here, but I'll say Ares as a company, very focused on serving the communities that we invest in and being a responsible corporate citizen. But under Joel and Keith's leadership, probably 5 years ago, we took that pledge to a whole nother level by connecting the growth and profitability of the firm to our philanthropic efforts. I was just to maybe end on a real happy note. Do you guys want to talk a little bit about what you're doing there? And I think you've been really innovative and leading, and I've been happy to see others following your lead. But for those that aren't aware of it, I wanted to give you guys a minute just to talk about all the great things you're doing.
Yeah, I mean, something that's out there publicly, so you can Google it on that side, is with regards to our flagship funds. We were the first with our flagship funds across alternative credit to donate at least 10% of the carry or the promote to global health and global education charities. And it's near and dear to our heart. It's something that we spend a lot of time on. I've been involved in global health for 12 plus years. And it really came out of that idea and a trip that I did to India, where we came back and said, well, what if we could tie these things together on the investing side along with the charitable tie-in? And I would say, look, it's the greatest story not written yet, which is it really speaks to, if you think of what we're trying to do here, it goes to the triangle and what we're trying to do across Ares, which is DEI and philanthropy as well as ESG. On the philanthropy side of things, we are trying to be the leader. We have been the leader. We're the first to have done it in that scale. And the dollars and the impacts are huge. That impact, if you think of the size of the capital and across what we have and the flagship funds, as well as what the broader Ares Foundation has done, in addition to that, those dollars and impact will have as much impact or more impact than many things across impact funds and others. And there has been others that have followed our lead, and that's the idea, right? We want people to continue to do this. We would love it if everyone had some form of a charitable tie-in, and it doesn't have to be global health and global education, but we do think that the impact that would have would be truly transformational across all types of charities. And I think from a culture standpoint, nothing has brought our team together more than standing under having a purpose and having a cause and having a reason we're doing things. And if you think about it, you know, we're working on transactions where you're investing $100 or $200 million, where you can tell somebody working on that deal that if this deal plays through and if we end up, you know, the fund performs, because we only do good if we are good on our investments. If we do that, then effectively that could be $1 million or $2 million that could end up going on to a charitable cause. So if you want to talk about purpose, where Wall Street sometimes has that problem of purpose, there's no better purpose than having a charitable tie-in and being able to kind of drive that impact. And I think it really speaks to Aries as a group. It really speaks to what we've been able to do, but we're hoping others will follow and continue to kind of drive those same kind of results.
Yeah, amen. Well, gentlemen, we are at time. That hour went by incredibly fast, as it always does. We covered a lot. And obviously we're available for follow-ups, both on the questions that were asked, but any themes that we talked about. But maybe just to finish where we started, we are going through a transformation in the alternative credit market. I think we are fortunate, having gone through the growth and development of the corporate market through the GFC and after. A lot of that pattern recognition that we saw in terms of the regulatory capital framework and consumer and customer behavior is now playing out in spades in alternative credit. So I suspect that you'll be hearing more of this from a lot of different capital markets participants, as, you know, kind of a sub sector of the private credit narrative. But it is one that is quite interesting, because it does tie in a lot of the things that are happening elsewhere in terms of banks and insurance companies and the consumer economy. So an exciting time for sure. Joel, Keith, thank you for your time as always. Really enjoyed it. I'm grateful that you asked me to be with you again.
Thank you, sir. We appreciate it. Thank you for the partnership.
Yeah, we'll talk to you soon.
Thanks.
Yeah.
Thanks, everybody.